few weeks ago, Terry Smith, the quality investor, released his shareholders annual letter where he talked about his performance, and we can get from this letter some potentially good advice to invest in the next year and some good lesson to be a better investor, even if you are starting to invest or if you already have a portfolio and you want to improve your performance. So first thing, he started directly with comparing his performance. So from 1st January to 31st December 2024, he had a performance of 8.9%, which is way below the market. Here he put equities, it's not S&P 500, it's MSCI World Index plus in pound, okay? So we have like a huge outperformance from the market on Fundsmith, and the S&P 500 is even more outperforming his fund, and the Nasdaq even more. So yeah, that's why he's comparing himself to MSCI World, because MSCI World on the long run is way easier to outperform than the S&P 500. He talked about Sortino ratio as well, but if we look on the long run, since inception, I think the inception date was in 2010, 1st November 2010, he had a performance of 14.8% per year compared to 12.1% per year for the MSCI World Index, which is pretty good performance. I think is slightly outperforming as well the S&P 500 on this. So yeah, on the long run it's good. It's just been not a very good year for him with this 8%, and he will explain why in this letter. He will also explain what we can get from all of this. So here, since inception, the fund has returned 2.7% per annum, more than the index with less downside price volatility. So you also gain more by investing on them, plus you have less volatility. So technically, for some people, less risk, even though if volatility and risk are not the same thing, but for a lot of people, less volatility means less risk. So it's kind of interesting. Then here you have some marketing things. Okay, our fund is the second best performer since its inception in November 2010, blah, blah, blah. The thing you need to understand is he is a fund manager, so he needs to keep the money from his clients, and also he needs to get more money. So I don't know if Fundsmith is still open for investor. I think yes, it is. So he needs more money, and he needs to keep the money from investor for them to not leave and go somewhere else. So most of his letter, I mean the first part of his letter, is basically like making you understand that yes, it wasn't a very good year, but at least your money is safe with us, and on the long run, look, we make good return, especially when we compare ourselves to MSCI World, which is performing less than S&P 500. Here also he make the same assumption and the same he say the same things that kind of everybody in 2024 as the starting of 2025. There is just 5 stocks, the fabulous 5, so Nvidia, Apple, Meta, Microsoft, Amazon, that provided 45% of the return on the S&P 500 index in 2024. This is similar to the concentration of return provided by the so-called Magnificent Seven in 2023. Moreover, a single stock, Nvidia, produced 20% of the S&P 500 return in 2024, which is pretty impressive. Like with 20% of the S&P 500 return is just Nvidia. So it shows how concentrated is the market. And if you don't have those stocks in your portfolio, you basically like don't have any performance. It's not that you don't have any performance, but more difficult, except if you go find stock which are not in S&P 500. Then he talked about the stocks that has a less good performance from his portfolio. Okay, so we had L'Oreal, IDEX, Nike, Brown-Forman, and Novo Nordisk. He explained here a bit everything from each stocks. The Novo Nordisk part is interesting. I mean, it interests me because I have it in my portfolio. Novo Nordisk was arguably our most surprising poor performer in 2024. So apparently, like it's it doesn't really understand, because he says it's surprising, so he probably doesn't really understand why it performs so less. So it may indicate that we could have an opportunity. His view on the long run should not change on this company. It remains the market leader in weight loss drugs, which it pioneered, and the years was marked by a stream of new news about other conditions, which is drug treat effectively and label expansion and application, which drug regulators seems willing to approve. Yet, not only did the share price fall 10%, but it finished the year on a P ratio half that its nearest competitor, Eli Lilly. So when you compare Novo Nordisk to the competitor, now the main one is Eli Lilly, they have half of the P ratio of Eli Lilly. While if you compare the quality of both business, Novo Nordisk is a better quality. So it's either Eli Lilly, which is way too much overvalued and should probably have a correction on it to match the valuation of Novo Nordisk, or other thing, it's Novo Nordisk, which is way too undervalued. And so we should maybe expect some upward for this stock, especially that the growth should arrive. The management expect between 20 and 25% growth for the next year, for 2025. In February, they will make more clear guidance, but it should be around here, especially that now they have acquired a new company and so on. So I think as well, Novo Nordisk is having a problem by the fact that they are not American company, they are from Denmark. So market will always pay a bit more for Eli Lilly. I think it's my personal opinion. Maybe I'm totally wrong on it, but I always have the feeling that Eli Lilly will be a little bit more valued than Novo Nordisk, even if they are same, everything same. You will always pay a bit more for Eli Lilly. In investment, it is always better to travel hopefully than to arrive, and there is certainly an arms race going and among drug companies to develop competitor drugs. Yet we are still dealing with a company in Novo, which is the market leader and holds production and labeling advantage. We should sustain that position. With revenues that are growing at 20% per annum. Moreover, we originally bought Novo because of its radical approach to drug discovery and will not rule out further developments. For the year, here's the top 5 funds performance. So here on the Novo Nordisk, what he say is, on one hand, he's very like mitigating it. On one hand, you feel that, yeah, like it's not normal that the stock drop that much, like it's totally irrational. But on the other hand, like he feels that, yes, the competition will start soon to be more difficult. And yeah, for now it's good, but let's see what happens in the future. Here he has the best performing stocks for him. So Meta Platform, Microsoft, Philip Morris, Automatic Data Processing, and Stryker. So yeah, those two, like great company stock. Philip Morris, a bit old company. ADP, it's also a good stock, but not a stock with very big growth. So I will expect it, like if you buy it, is either because you have it in your portfolio since very long time, or because the value is very, very low. I don't know, but it's not the company that I will buy. And Stryker, I don't know it, to be honest. So here he explained, giving the number of repeat appearance of our top 5 contributor, I'm tempted to repeat one of our mantra, which is that you make money with all friends. However, 3 of those old friends, which have been repeat contributors, were detractors this year, namely L'Oreal, IDEX, and Novo Nordisk. So he keep his company for a very long run. Since now it was working well, but this year, the companies that he had for a long time didn't really give him good performance. So we'll see what it will go. However, if anything, I will regard this as a blip in their long-term record, and we intend to mostly patiently await a return to form. In our view, they are simply too good to sell and risk being uninvested when the tide turns. So yeah, here like the message is clear, is we don't want to sell them because there is, first, we need to find better company for the long run. And now at this price, they seem undervalued. So why selling something undervalued to buy something else which we don't even have the certainty that it will perform well? I think here for IDEX and Novo Nordisk for me, great company, okay, great quality stock. IDEX, I don't know it very well. I have it in my watch list. I need to deep dive on it, but from the first thing I saw, it's a good business as well. They have good numbers. L'Oreal, I think they depend a bit too much on China. I find them like quite a bit cyclical lately. And the thing that I have problem with them is they are in Europe, in France especially. So yeah, I'm a French person. I should support company from France, but I don't really. I feel you can have company with a better growth prospect than L'Oreal. I feel that they arrive a bit to the top of the market. Not that they cannot grow anymore, but I have less good perspective from them than IDEX or, for example, Novo Nordisk that he have in his portfolio. Here are the three big lessons, okay, that you need to remember from investment, and I think it applies to everybody. Buy good company, don't overpay, do nothing. Like literally, it's not because some years you will have a bad performance that you need to sell your stock, that you need to get out of the market and so on. Keep your company, especially if they are a great business, and eventually, if the price is even better, maybe invest more in it, okay? Here's a comparison of his portfolio with the S&P 500 and FTSE 100 with different criteria. So for the ROS, so return on capital employed, you can see that on average, his portfolio for 2024 was 32% compared to 16% for S&P 500. 16% for S&P 500 is quite high. Here 32% is really good. Is really good. On the long run, it should pay, okay? Gross margin, same, like higher than S&P 500. Operating margin, 30%, higher than S&P 500 as well. Cash conversion, same than S&P 500. Before it was way higher. This year it's a bit less, probably because he owned some tech stock like Microsoft or Meta that invested a lot of money. So they have a little bit less cash conversion, same with Novo Nordisk that invested a lot in 2024. So this could reduce it. And the interest coverage, 27 compared to 9 for S&P 500. So yeah, it's pretty good. The company on a great quality. Something I would like you to note on this is, since the beginning, he's comparing the data from his portfolio with S&P 500, okay? Multiple times he talk about S&P 500, S&P 500, the performance I have S&P 500. But yet, when he compare its own performance of his fund, he do it with MSCI World. This is pure marketing. It's just because the number seems better compared to MSCI World than S&P 500. Because when you look at it, you may see, okay, the outperformance is not that much compared to S&P 500. So let's take something that will outperform a bit more. So this is just pure marketing from here. Okay, let's continue here. Something else that I highlighted. The only metric which continues to lag its historical performance is cash conversion. Okay, so it's what we saw here. Alphabet, Microsoft, Meta, Novo Nordisk now is racing to build production capacity to supply enough of its weight loss drug Wegovy and finish the year spending 10 billion purchasing the manufacturing sites. The tech company are in a race to build capacity of artificial intelligence in the form of GPU chips and data centers. So it's what I told you before here. The cash conversion is mostly due of the significant investment. Our portfolio consists of companies that are fundamentally a lot better than the average of those in the S&P 500. So it's no surprise that they are valued more highly than the average S&P 500 company. We sold 3 companies and purchased 2 in 2024. As last year, this may seem like a lot of name for what is not a lot of turnover, and in some cases, the size of holdings sold or bought was small. We have held 4 of the portfolio companies since inception in 2010, 9 for more than 10 years, and 15 for over 5 years. So he show here is they are long-run investor. I feel really the thing he tried to tell in this letter is to have long-term thinking, to see on long-term. It's not because 1 year wasn't very good that the next year will not be good. It proved in the history that on the long run, it's good. They sold McCormick, Diageo, and Apple during the year. I don't know those two companies. For Apple, I can understand the valuation is being pretty high for companies that don't have that much growth. Then we'll see. Maybe it will have better growth in the future. But for now, the growth it's not that big. And even Warren Buffett is selling his Apple shares. He still keep a lot, but he sold like 50% of his portfolio, of its stack on Apple. So yeah. So Diageo, which we had owned since inception, exhibited problem with its new management, shown by a lack of information about its Latin American business, which produced results far worse than the sector in this area. Moreover, we suspect the entire drinks sector is in the early stage of being impacted negatively by weight loss drugs. Indeed, it seems likely that the drug will eventually be used to treat alcoholism, such as the effect on consumption. So yeah, here you make an assumption that is pretty about long term, and I don't know, it's really difficult to do those prediction. I feel here it's more like, I agree that you sell a company when the management is being not good, that they don't show good numbers, that they have bad results, especially on the long run. But here, selling a company because you're seeing that because of new drugs that is arriving on the market, people will stop consuming this and this. This, for me, it's a bit far-fetched. I don't know about you, but I think you could have better reason like to sell the stock, but I think the main one is this, and here is just to confirm his view. Then about McCormick, being disappointed by the slow response which the company exhibited in its ability to pass an input cost inflation, so compressing its margin, together with its exposure to on-label competition, which has stifled as inflation has caused consumer to trade down. So problem with the company, inflation, so a lower margin, they couldn't rise the price same as inflation to not lose customers, so less margin. So they thought. When it comes to Apple, they start buying Apple 2 years ago at 156 a share when the PE was below the S&P 500 average. So it's a company that they didn't keep in the portfolio for long, because they sold it because now it's way too, like the sales grew just 2% last year and 50% higher than the S&P 500. So yeah. Now they start buying in two stocks. This can be good for your watch list for the year, or to get some nice ideas of stocks that you can analyze, because he is a quality investor, so you can expect maybe those stocks have some good qualities. So they start purchasing in Atlas Copco and Texas Instruments during the year. Atlas Copco is a Swedish industrial company which makes compressor, vacuum equipment, electrical and pneumatic tools, and which has three characteristics which we find attractive. It outsources much of the manufacturing, so making capital light, which enhances returns. Highly decentralized with over 600 operating entities which have comparable autonomy addressing their local markets. And this is control instinct held by the Wallenberg family vehicle, which should lead to good long-term decision making, since they have been in the business for more than 151 years this year. So yeah, also some studies show that when it's a family business, it had a better performance on the long run. So this company, Atlas Copco, maybe it could be interesting to put it in your watch list and start a deep dive in this stock. By the way, let me know in the comment section if you would like maybe that I do a full analysis on this company. Then when it comes to the other company, Texas Instruments, it's a manufacturer of analog and embedded microprocessor. To be honest, I'm not very familiar with this area, this sector. Not that I don't know, but microprocessor, semiconductor and so on, it's really not something that I enjoy reading about, that I enjoy analyzing. I don't really understand the moat in those business. I don't really understand how they have competitive advantage on the long run. I can understand on a year, 2 years, 3 years, but on 10, 20 years, I don't really understand. So that's why I don't really invest in this sector. One is that it may have become more focused. It had been seen as a driver of share price of company which had previously held, such as Adobe and eTwint, both of which had bottled their copybook with us by engaging in overpriced or seemingly ill-conceived acquisitions or attempted acquisitions. So yeah, he is not happy with the management and what they do with the money in those companies. So that's why he didn't do anything with them. During this period, commentators have frequently asked whether the AI boom is the same as the dot-com era and therefore will have a similar ending. In response, I'm tempted to quote Mark Twain: history doesn't repeat itself, but it rhymes. Undoubtedly, some of the AI enthusiasm is hype, as was the dot-com mania, but there are a couple of key differences. First one, the leading company in AI boom, Nvidia, is very profitable. Okay? Remember, during the dot-com mania, the company were not very profitable. Okay, some of them were absolutely not profitable. Some of them didn't even have earnings. Okay, revenue. So yeah. And the second thing is the rise of so-called passive index fund, and he call it so-called because it's not that passive. Okay, now in 2023, passive investment via index fund exceeds the amount of assets held in active funds for the first time. Okay, only about 10% of AUM was in passive fund, as were even do understanding with the label with some use investment. Index funds are not truly passive strategy. They may not fund manager taking investment decision, but such index investing is a fact, a momentum strategy. Okay, the vast majority of index funds are market capitalization weighted, like the index on which they are based. The size of holdings in the company in the index fund is based upon their market value compared with the market value of the index. So when there are inflow to index funds, the largest portion go to the largest company and vice versa when there are outflows. The result is that money flow out of active funds and into index fund as it has been doing. It drives the performance of the largest company, which are companies whose share have already performed well, which is how they came to be the largest company by the market value. Okay, this is self-reinforcing loop, which will operate until it doesn't. Okay, the idea here is, okay, now you invest in passive fund in an index, the money go majoritarily to the biggest company till everything crash, every investor get out of those company because the valuation is way too high, and then you can have kind of a bubble on the index. It can burst, and we'll see. Okay. Here I talk about what difference there is between Meta and Nvidia. So I don't really understand why he makes a comparison between those two companies because they are two different companies. Like Meta is social media platform, advertising, and so on. Nvidia is selling semiconductors. So I don't really understand the comparison here, but the idea here is like Meta serves 3.3 billion consumer and several million advertisers. Nvidia demand is dominated by literal handful of so-called hyperscaler building a data center to handle large language model of AI. So the idea here is like, okay, Meta has thousands and thousands of customers, advertisers, okay, 3.3 billion users, while Nvidia, they just have few customers that they sell a lot of product for the next year because there is this AI mania. Okay, this part we can pass. And here, before its share price fall, Meta was on a P of 28, whereas Nvidia is currently of a P of 54. So the idea here is like Meta seems a better business, have less concentration in few clients, and also should not burst when the AI mania, let's say, will get out. Also, the P ratio is way lower for Meta than for Nvidia. And this is a personal note. If we take the Magnificent Seven and we go in time in 10 years or 15, 20 years, I think there is more chance that Meta will still be here than Nvidia. If I have to bet on one of them to be still there in 10 years or 15 years, I will bet on Meta rather than Nvidia, because I really don't feel Nvidia have a big competitive advantage on the long run. Now, yes, they have good product for the good market. They have a great timing, so they make money, great. For the next 2, 3, 4, eventually 5 years, why not? But for 10 years or more, I don't know if we'll still see Nvidia in the Magnificent Seven. Let me know in the comment section if you think it will be. So the main thing to remember from this letter from Terry Smith, I would say that he do a lot of comparison with S&P 500, but then he compares portfolio performance with MSCI World. So it's purely marketing. I feel that he had a not really good performance this year, but good companies have been very cheap. You have some great opportunities. So it can give some nice investment insight, nice things to put in your watch list, like for example, IDEX, Novo Nordisk, okay, maybe this Swedish company that he just added in his portfolio, I don't remember the name, which is Atlas Copco. It can be interesting to analyze the stocks, but keep in mind that don't invest just because a big investor invested in those companies, or don't sell because they sell. You need to deep dive into those companies, understand the business, and then you will take a decision, because if you don't do this, you may have some serious trouble in the future.